Good morning, everybody. Welcome to the Flow Show. How you doing, Stel? You good, mate?
Oh, good, mate. Yeah, and you?
Yeah, not too bad. Not too bad. Watching these crazy markets.
Crazy markets tomorrow. Tomorrow is a big day, mate.
Well, it's big enough. The last 2 days so far. Yeah, it can always get crazy out, as we well know.
Yes.
Well, I don't know where we'll start today. Well, I'm not going to start in China. I'm going to start in Europe, I think. There's actually not been too many headlines out overnight, so this bit might be short and sweet. ECB's Herodotou says policy tightening is the only tool to fight inflation. ECB's Villeroy says doesn't see a wage price spiral coming in Europe or France for that matter, which is a bit strange because they've had pretty much as many strikes as we've had here in the UK, but maybe he's got his eyes shut for that one. Coming over to the data first thing. Something from last night, just want to keep an eye on and just highlight US consumer credit missed expectations by a big chunk, was expected to come in at 20.5 billion, came in at 7.24 billion. That may be highlighting tighter financial conditions, resulting in the consumer not borrowing as much money, which can then have an impact on potential spending habits if the US consumer is feeling a bit of a squeeze over there. Coming over to, we'll start with Germany. Rates were unchanged. Inflation rates were unchanged in the final numbers from Germany. Again, these numbers went up pretty sharply in June from May. This was due to the transport subsidies that Germany had in place last year, and we're seeing that annual effect taken into account here with that higher number. So they subsidised, made transport cheaper June last year. Obviously, there's no subsidies this year, so therefore the prices are much higher. Hence that big jump. So not exactly maybe telling a true picture or true reflection of inflation in Germany. That may last a couple more months. I think the subsidies went through till September, if I'm not mistaken. So it could be we see these sort of similar numbers for the next couple of months until all that washes out once again. Italian industrial production came in fairly hot at 1.6% versus 0.7 expected and down 2% prior. However, year on year wasn't as bad as expected, at minus 3.7 versus minus 4.5 prior. It's a little bit better over there in Italy. Germany's ZU came in worse than expected all round. Headline number minus 14.7, was expected minus 10.5. Current conditions getting worse than last month, though not as much as expected. And the same for the Eurozone number as well, coming in minus 12.2 on that one. Some decent data from the UK, depending on what you call decent data. Employment or the claimant count was higher, 25.7. So those claiming being out of work rose to 25.7. The employment change 3-month was a bit softer at 102, but still, again, unemployment rate jumped 2 pips. But all the noise, all the news was in the wages data again. Average hourly earnings, including bonus, jumped to 6.9%. Doesn't look a big move, but that was revised higher last month, still beating expectations. Take away bonuses, and it rose 2 pips more than expected at 7.3% versus 7.1 expected. It looks unchanged, but only because that was revised up in the prior month as well. So either way you look at it, it's hot because it was either hotter than last month with that revision, or it's unchanged this month. Now I looked into some of the details for this one, and when you look at UK wages, you have to sometimes look at the details, and we have obviously private sector wages and we have public sector wages. Now, public sector wages are usually always depressed and have been for donkey's years. However, they printed the highest reading since I think it was the September-November period in 2001. So 22 years ago, it printed 5.9%. This time it printed 5.8%. Why is that important? Because public sector wages are paid for in large part by the government. So this is a financial pressure put on the government to pay out all these wages. Hence why they're so steadfast in fighting against some of these pay disputes, because they're the ones that are going to have to pay for it. Private sector wages are up 7.7%. Now, some other components within the private sector showed strong wage gains, like financial services. Wage hikes were 9%. So all these wage arguments that people are having and strikes and whatever, they are still feeding through. And we've been saying that for weeks. This is still the big pressure for UK inflation, still the big pressure for the Bank of England. Hence why they keep hoping that wages don't keep going up, because they will provide a secondary wind for inflation. And this is the fight the Bank of England have now got. We are starting to see energy prices coming down. Household bills were cut in July from all those hikes we saw last year. So there are pressures coming out of inflation, but there are pressures still going into inflation from wages. So it's a bit of a fence sitting exercise at the moment as to which one is going to outweigh the other. But these wage numbers are certainly going to put a big impact in to the inflation picture. Still, we were talking about this yesterday, and the numbers to watch were always going to be those wages numbers. Bank of England rate expectations were now pricing a 70% chance of a 50 pip hike at the August meeting.
Yeah.
Make of that.
Yeah, well, we've been talking about these numbers, and they are the important numbers, and they came in higher than expected. And not only that, including bonus, they're actually higher than the last print, and that's worrying. So what can the Bank of England do? They kind of have to go with their mandate, which is inflation within the limits, and it's clearly not within the limits. So the market's pricing a big chance of a 50 now. I think that's fair. Unfortunately, they have no other choice. And of course, they're going to be killing the economy by raising rates more and keeping things tight. But that's the only instrument that they have. It's the only weapon they have. So I remain of the opinion that the Bank of England, for once, will be a little bit more hawkish. They always tend to be dovish, but now they have really no choice. So I think they will continue to be hawkish and hike more than other central banks. And that's why I am still constructive the pound for the next few months. I'm not saying that it's going to be, all nice and dandy forever. No, but for the next few months, maybe for the remainder of the year, this central bank policy divergence is, I think, going to cause the pound to go to outperform, and it has been performing well. Look at the cable; it's above 129 now. Euro pound 85.25. I still think Euro pound is going to be heading towards 83s, but when that happens, I think that's when the market will be pricing a bit too much, or will be expecting a bit too much from Bank of England, and that will be that. So for now, to answer your question, what can the Bank of England do? I think a 50 is likely coming, and I think the market is right in pricing it, because they can do nothing else. What would you do if you were in the Bank of England? What can you do without looking like an idiot? That's the problem. No, that's the problem, unfortunately. Gavin says resign. Yeah, they should have done that long ago.
Exactly. Yeah, I mean, they put themselves in this position. Yeah, so no sympathy from me. As you know, they should have had rates up this high a while back. But yeah, I think they are going to be forced to go higher, and that's going to create a bigger problem for the UK economy. The only thing I would say, thinking about the wages stuff, is that if there is a downturn, if inflation pulls back and there's a downturn, all these people who are getting 7%, 8%, 9% wage increases, and suddenly inflation falls back, i.e. cost of living comes right down, they're all going to be loaded. So I can see a situation where we get a short-term negative impact from higher rates that maybe only lasts a quarter, and then we get a real strong rebound because all of a sudden everyone's flush with cash because all their bills have gone down and their wages have all gone up. So I don't think it's going to be as smooth a ride into economic weakness and out of it as you might get in, say, the US, maybe even Europe. I think it's going to be a case of short, sharp shocks on both sides of things. So that's going to be something you need to keep an eye on. You know, if the UK does see weakness, I don't think it's going to last for months and months and months. I think we may get, as I say, a quarter, maybe a quarter and a half, 2 quarters, and then we potentially see those wages suddenly showing some positivity. Just everything running on a faster timeline in the UK is my view. But sticking with the UK, and 2-year fixed mortgage rate has risen to the highest since Liz Truss's mess, or what some call Liz Truss's mess. 6.66% is the rate for the 2-year fixed mortgages. And the FT are reporting that homeowners are rushing into new mortgage deals because they're fearing further rate hikes, and they want to lock in now at at higher rates before they go even higher. If that is the case, you will be able to see that in effect in the next couple of reports of UK mortgage approvals when we get the BOE consumer spending and borrowing data. So here's some real life fundamentals you can keep an eye on. If mortgages are being piled on, that's going to appear in the data over the next 1 or 2 reports. So keep an eye on that one, where you can see the fundamentals in real life. Coming over to the US, Fed's bar had some stern words for banks, saying that the large US banks are going to face stricter capital rules under their coming proposals. They plan to propose several changes to bank capital rules in the coming months. It did say that most banks already have enough capital to meet the new requirements, most banks. Part of what's going to happen is that banks are going to need $2 extra capital per $100 of risk-weighted assets. So they're going to have to put in the coffers $2 for every $100 of risk they've got on the books. Speaking on inflation, he said, we are close, but still have a bit of work to do. Fed's Daily says US economic momentum continues to surprise her. And in the context of that momentum, there's more we need to do to raise rates. We are likely to need a couple more rate hikes this year, but we may end up doing less or more than a couple of hikes, depending on the data. We are at the last part of our rate hiking cycle. Fed's Mester was sticking to her hawkish guns, saying it's too early to say whether the neutral rate has shifted much. Doesn't think that rates are that restrictive so far. It expects housing-related inflation to ease, and a bit of a warning for some of her colleagues by saying prematurely declaring victory on inflation carries costs. One of those is Bostic, who said policy right now is clearly in restrictive territory and the Fed can be patient. Businesses are still hiring rather than preparing to lay workers off. That's indicative of resilience. Quickly looking at the Bank of Canada, and JP Morgan now joined the club of those expecting the BOC to raise its policy rate to 5% on Wednesday. So previously didn't think they'll be hiking, now they think they're going to be hiking. That's all I've got so far. Stel, you got anything you've picked up this morning in your tea leaves?
In my tea leaves. No, news-wise, no. The one thing that could eventually become important is the whole story about Sweden joining NATO and Turkey agreeing to support it. But I think they're asking for stuff in return. You know how the Turks are. Nothing really crossing my radar, let's say. Those little pieces of data that you talked about and all, it's been relatively quiet, and the whole market is kind of holding its breath for tomorrow. So I think today Well, actually, no. Today we're already seeing some moves. We're going to talk about those, but nothing else to mention. No.
Yeah, a quiet day on the data front. Absolutely nothing out apart from the NFIB in about 14 minutes, but really dead on the data front. We do have Bully Bullard speaking later, as you can see there. So we'll have to see how hawkish he remains, or whether he's starting to change his tune a bit regarding rates. One of the big hawks over there. Yeah, as Dale mentioned, there's been some big moves. Dollar yen keeps getting absolutely pasted. This time it's got a double wind with yields pulling back as well. 10-year yields back under 4%. Now, there's a few people clutching for reasons why this is happening. One of the reasons that's been chucked around and was being chucked around yesterday was there's a report or an index run by Mannheim on used car prices. It's a used car price index, and there's been a few people jumped all over that because it showed the biggest drop ever on record, down 4.2% or something on the month.
Give me 2 minutes. Somebody's at the door. I'll be right back, Ryan. Okay.
Yep, no worries. So a lot of people are taking that as a bit of a harbinger for inflation. If used car prices, which has been one of the big things that people have talked about on the way up. I did look into this thing. It's one of those, I think it's one of those items where someone's pulled it out of somewhere and now everyone's talking about it, whereas a day ago no one knew it even existed. But if that's what the market wants to trade, the market wants to trade. However, when I looked at the chart that everyone was jumping over, this thing has been coming down since late 2021. So it's in a trend lower, a 2.5 year trend lower. So it's a bit kicking open an open door, in my opinion, in terms of a reason. The consumer credit data, again, potentially another reason why dollar yen's come down, or rather yields are pulling back. Although a lot of us were wondering why they went up through 4% in the first place, but they're coming back down again now. Another reason is a lot of people been talking about is an unwind of the carry trade in dollar yen, which again I'm skeptical about, because fundamentally nothing has really changed between the US and Japan in terms of rates. So why everyone would be starting to get out a good trade that may not be even changing for the next 6 to 9 months, I've no idea. Other carry trades aren't reflecting that as well. Dollar MEX, which I took along in yesterday afternoon, down in these lows. You know, when we had this bounce to 1740, everyone was talking about the carry trade unwinding. Well, here we are back down at the lows again. So I'm not overly confident in people's explanations for what's happening in pairs like dollar yen. So when I get like that, at the end of the day, all I can look at is the charts and see what it is doing, and try and work out what it may do at certain points. So for me, there's no denying we've had a big move. It's found 145 solid. You look at a long-term chart, there's a reason why I was highlighting this level for weeks and weeks, because it was a big, huge level historically, as we've been pointing out, all the way back. Whoa, here we go.
I'm back, by the way, with my lunch.
All the way back to the rally last year. It was a big stall point on the way up, and when it broke, it was a stall point on the way down. So, you know, the 145 we've been talking about forever, and it's held. So technically, this is our big, huge level that we need to pay attention to. Now, on the shorter term and the context terms, we're not even down to the 38.2 fib of this whole move up since March. So this has been one-way traffic since March. Yeah, this is a pullback. There's no denying it. It's a big pullback. Does it mean the trend's broken? Not yet, it doesn't. Until we start breaking some of these fibs, the trend is still in play, in my opinion. Now, I'm not ready to start fighting these moves until maybe we get to another big level. 140s might be worth having a look at, 139s. The big level is still down at 138. That was the big one we played latter part of this year, and into this year it was a big break point. So that's the main level you want to look at, which sits pretty much in between the 38.2 and 50 fib. So if the 38.2 doesn't hold, that's where I will consider catching a knife, depending on how we get there. But for now, I know a lot of people have in our room was short up here near the top. Great trading. You've got some good money in there. What you need to think about is what happens next. If you want to see further profits, you've got to worry about whether we can break some of these levels. We do have, as I say, this intermediate level around about 140. It was a bit of an area on the way up. As you can see there, it was a bit of a break point as well back in November. Then we've had a bit of mooching around there. It was support in the last instance before we had the big shift up. So that's maybe somewhere where, if you want to put the butcher's gloves on, as K-Man would say, that's somewhere you can maybe look to try it into the big figure, and then maybe down into these lows of the 139s and that 38.2 fib. But until, as I say, until we start crashing through some of these fibs, the trend is still valid, in my opinion. Doesn't mean we're going to go all the way back up to 145 in a blink, but it may mean we're going to have to step up and step up again. Resistance is coming in where it needs to come into, to just come into a shorter time zone. So all these levels that we broke on the way up and found support, we're now finding them as resistance. Again, it's that magic way that the techs work. These lines have been on my chart for quite some time, and here you can see them. We're breaking them, we're holding as resistance. We're breaking them, we're holding as resistance. So that's when you see a pattern like that, then you know that the short-term trend is continuing to go in one way. Until this trend starts to change, you need to get above these smaller levels, and if you don't, then we're heading further lower. So context, as I say, you got a longer term trend which is up since March. The shorter term trend is down, and when those paths cross, that's when you get your action turning in. So there's a lot of tech down here at the 139. That's if we get through the 140, but a lot of tech confluence down here at the 139, 139.20s. So if we do continue lower, these are the bigger traffic zones you want to be looking at if you want to counter these moves at the moment. And if you're short, these are the areas you want to potentially look to take profit if they're going to show up and not let you through to further profits on the downside. Now, as mentioned, the $MEX is another carrier. I know Blake's been in this one for a few days, and I've joined him as well, because we are, you know, last month or so, we are seeing signs that perhaps we're not heading lower just yet. This 1700 or 170005 area, bit of a solid area at the moment. It's shown it's got the ability to bounce, so that's encouraging if you're long down here. However, I don't like the way the speed that this has come down. Again, back to the level. I don't like the way we're not bouncing an awful lot. We're just sort of dragging along the floor. So this one's got a question to ask. Is it going to bounce off this level, or is it going to break the level? If I had to put a number on it, I'd say I'm probably 70-30 that we get a break down, which is why I'm long here, but I've got stop reverses into shorts, because I think if it goes, it's going to go bigly. And if it does, there's a bit of a black hole underneath, at least down to, you know, mid to low 16s. So I think if this goes, as I say, a bit of a trapdoor, we could pull down back here. But again, if the clock ticks and we don't break it, that sets up the chances of having a bigger move up off the level. Maybe we go through the 1740s at the second time of asking, and maybe even move up to the 1760s or more. So bit of a range, quite a tight range for this pair. So if you want to trade it, there's potentially good risk reward down here, because you don't need to have a big trade. You can always flip it to a short. And conversely, if we do get a break either way, it's going to likely have some legs on it. So you should get some decent pips out of it. Looking at cable, and we're into the 129s. I'm glad now I sat on my hands for a bit and didn't short it or scratch my itch to be short. I may do that up at 130. That's going to be the big level. We've been talking about that one for a while. So I may look to have a crack at that one, both for a longer term trade or rather longer than a short term trade, as well as a scalp off the big figure. If we get a move up there today, and depending on the driver, I may scalp a first test and see if I can hold on to it for a while, see where it goes from there. But I've still got an itch to be short. I just, as Stel was saying as well, I don't think now is the time. Euro sterling was bemoaning that we were bouncing yesterday. We're now back into this support area down at 85.20s. Again, it's another case of the price coming back quickly to this area. This is now the fifth, could call it the fifth time of trying this area down here. So if we get a break here, that may put this 85 level under pressure. If this has got enough volatility in it to break through 85.20, it may take out the 85 as well if it's got enough pace behind it. So as much as I've been looking at for long, I'm less confident. Doesn't mean I won't try it, but I'm less confident in it working. But then this is euro sterling, so it tends to go a bit slowly. If we do bust through there, then I am going to start thinking about building in a small position and taking it down to the 83s, 82s, wherever it wants to go. Because I think if we do get there, as I've been saying, that's where we're into extreme pricing for what the Bank of England is going to do. Stel, you got anything you want to jump in with?
Yes, I do.
Do you want me to?
I'll take the screen.
Yeah, no worries. And then I'll grab it back after.
So, okay. So we're preparing for the big kahuna tomorrow. And we've talked about the employment numbers being, well, I want to say mixed. The ADP was massive, but then payrolls disappointed. But the data, the details were not great, in my opinion. Anyway, we have CPI tomorrow, and I want to share something with you, which is very interesting. A very nice man on Twitter shared these two charts from the BLS, but he made them look very nice. Steve Anastasiou sounds Greek, actually. He probably is. So he's talking about the lag that hold on a second. Yeah, so the lag that shelter has as a component of CPI. So shelter is something that is a lot slower to react to the changing conditions in terms of how quickly things get more expensive and then or cheaper and vice versa. And we have here, let me move this out of the way. Hold on. I hate this. Okay, so we have CPI. So this is headline CPI. And you have the orange line is X shelter. So you see as headline CPI rises, this thing is a little bit, sorry, the lag of yes. So basically the headline CPI, which includes shelter, does this. And X shelter is a lot faster to go up and a lot faster to go down. So if you look at this headline number, it started rising. The X shelter number started rising way before the headline. And it stayed higher, and now it started falling before the headline number, including shelter, and now it's a lot lower. So X shelter is at 2%, which is target. Let's not forget that. Similar story for core. Again, the same thing, and again, there's a lag, and core CPI X shelter is at was below 4%, so 3.5%. So this theoretically is an indication that the headline CPI, the total CPI headline and core are going to be falling because shelter is a lot more, it lags a lot more, and it's going to be catching up basically to the downside. So I said yesterday, and I stand by that. I think we will see a two handle on the headline CPI number. So 2.9 is my guess, and 4.9 for the core. And I think they will continue to grind lower, including the core. So this is very interesting, and it's something that I actually agree with. And so what does that mean? If that does happen, and if CPI does surprise to the downside or does come in at expectations or maybe marginally lower, what happens to markets? And I think that the markets are going to get spooked by this. because we are now pricing a almost 90% chance of a hike next meeting. I think at the moment with what we have, that's done. There's no way the Fed wants to disturb the markets or shock them in any way. But if CPI comes in lower, if we get a two handle in headline CPI, that gives the Fed enough reason to say, look, we're looking, 6 to 12 months forward. We think that we've done enough already to bring inflation down. They don't want to kill the economy. They don't want to bring inflation down to 2% and then all the way down to 0. Then they're going to have other problems. They're going to look like even bigger morons. But I think that will give them reason to say, hold on, maybe this skip could be a pause. And we see, we look at the next reading and the next. There's no, as long as the direction is the right way and the pace is also pretty decent, there's no reason to overdo it. Yes, they've told us over and over, yeah, we're far from inflation being a target. Yes, but look, we could potentially be 2 or 3 months away from inflation hitting target. So I'm sure that this is something that's going to be in the Fed's mind when they look at the inflation print tomorrow for the next meeting. And I really would not be surprised if the markets go from pricing 90% chance of a 25 hike next meeting this month to 50% chance. I think that's very doable. And if that happens, then the Fed can easily pause completely, not hike, and not shock markets. So it's a big number. We always say that, don't we? This is the biggest CPI print since the Mesopotamian War in 500 BC or something. No, but all jokes aside, this is an important number now. And as I've said over and over again, for me, inflation is a lot more important. It carries a lot more weight than employment, particularly in the US. So what happens with markets? Yields are in danger because we had this breakout. We've been talking about this being a bullish formation, but fundamentals for me were not really confirming this. But nevertheless, this was a bullish formation and it did break out. But now we're coming back close to the breakout level. And I'll tell you what, if CPI disappoints, we're going to go back in. And if that happens, then a forced breakout will spook the markets, I think. I mean, if the CPI comes in low, it will spook the markets. And let's not forget, I read it the other day, I'm sure it's probably still the case there or thereabouts. Speculative shorts in bonds are near all-time highs or basically at extreme levels. So you can deduce that the market wants yields to go higher. Or is positioned that way. So if this becomes a forced breakout, then you can be sure that people are going to be covering. And that's going to bring a squeeze, et cetera, et cetera. We will go right back into this structure. And I think after that, it's a matter of time until we test the lows and break them. So yields are in a precarious situation. Of course, they could, come back lower, retest, and then, boom, we go. But this will mean that CPI has been strong. We're above expectations. We're expecting 3.1, if I recall. Let me check. Tomorrow 3.1 on the headline and 5.0 on the core. If it comes in line, I don't think the market is going to treat this as being hawkish or being yields higher. I don't think so, because it's still a decent drop and the direction is still there, etc., etc. I've talked about this so many times. So, but if it does come in higher than expected, then by higher I mean not 0.1, something more significant, then I think the risk is for yields to keep going, to just bounce off of these levels and go higher. But for now, I think the biggest risk is for yields to form a false breakout, and then there's going to be trouble. The stocks, well, we know that in the short term, stocks are inversely correlated with yields. So as yields drop, stocks find support. I don't think it's going to be different this time. We get a disappointment in the CPI and yields drop. I think we're going to be taking out these highs here. We're about, 40 points away. And what's the next level? 4,500? There's a fib here, 4,530 something. 4,500 to 4,550, nice round numbers. But for now, is this looking bearish in any way? Nope. It isn't. And we've said this, I mean, we've said this from the breakout. Remember that, from the breakout all the way. And there's nothing technically to say that this move is ended or is close to ending. So if you want to be short risk, I would say, obviously you do whatever you like, but I would say don't be too hasty, because if you had wanted to short this rally, of course, if you're a day trader, you can do well, but it's all about timing. This rally has been pretty strong so far. So I don't see any technical reason to say that we are near a top. Okay, so the dollar. The dollar is looking weak because yields are now dropping back. It's interesting because the dollar has dislocated a little bit from yields. So yields had been shooting higher and dollar went nowhere. So now that yields are reversing, the dollar's dropping pretty fast. 100.80 is the level, and we're now less than a big figure away. So it's getting dangerous. I think with a weak CPI, we're definitely going to test that tomorrow. And as I've said before, I think the dollar will resolve to the downside because I don't think inflation is going to be going higher. I think inflation is going to be going lower and going to be disappointing. So with the dollar going towards support and testing this, what do I think is a good currency? Well, I think the euro, dollar, and cable are not bad currencies to be long. So the euro and sterling to be long against the dollar. We're close to these highs here, about 90 odd pips away in the euro dollar, and cable is looking even better. I like cable a lot more. We talked about this at length. We've been talking about this from March. It is a breakout. It was a little bit hesitant, but now it's looking like it's got some legs, and the UK data is strong enough, and the inflation data is strong enough to basically force the Bank of England to hike more. And I really don't see how they can not do that. So the pound is taking out the highs. It's making new highs today. Anything bearish about this? Of course not. So I think this is a one currency definitely to be long or to stay long against the dollar. While we're looking at the pound, might as well look at euro pound, which is now again close to these lows. And this bounce here wasn't, if you look at the move we've had from the 90s, well, almost 90 down to 80, 85 and change, and then this retracement here was very shallow. Actually, let's see, how shallow was it? Just above the 23.6. So really, as shallow as it gets. I am still bearish euro pound with a target in the 83s. 83 to 83 and a half, I think, is a good level to be reconsidering. And the euro pound I really like because it's been trading within this big range, 82 to 90 for quite a while. And it's one of those things, like Ryan said, it moves relatively slowly, but it tends to trend a lot, and I like that because I'm not a day trader. I like to ride things which are not terribly volatile. Once you get the direction right, it's easy for other pairs to kind of knock you out, right, and then resume the trend. So euro pound is one I really like being short, and cable is a pair that I like to be short dollars against, so against the pound. The yen, I think Ryan said it right. We need to, it is a downtrend here, but we really need to break levels like, 137, I think, is the level, because you have these couple of highs, lows here, this area, 137. If we break below 137, I think that's going to be looking good for a short. But I haven't traded yen for a while, actually. Norway, almost there on the euro Norway. You could say either this horizontal line, which is at 1141, or really, if you want to be very prudent, below 1138, let's say. Once we break this head and shoulders neckline, I think that's going to be a clear signal, and I am definitely going to go for a short here. Dollar Norway is another one I like being short against, and it's actually breaking. Damn, I just saw that. I didn't realize. I think I'm going to short some of this. Yeah. Wow. Okay, as soon as we're done here, I'm gonna short some. So, what else for currencies? Dollar CAD. Remember, we're talking about a test here. I was saying I want to short a retest. I don't know where I was that day. I missed it completely. So that now, would I chase it? Yeah, dollar CAD is not a bad, the CAD is not a bad currency to be short against. Sorry, to be long against short dollars. But the move was started, and I kind of feel like I've missed the, the train has left the station. But anyway, that's my view. I think CPI is going to disappoint. I think the dollar is going to go lower, test the lows. I think yields are going to go right back into the range and cause it to be a false breakout. Cryptos, well, what can I say? This was a very impulsive move on the back of the ETF that was it BlackRock they made. And we're consolidating. So this theoretically is a very nice bullish consolidation. And if what I think happens, which means that yields go down, risk goes bid, then I think Bitcoin breaks above these highs and goes on to next levels, which are, what are they? I have no idea. Oh, this is also a big zone here. So yeah, this could be, if we break above 31.5, 32, wow. I don't know, actually, where do we go? Let's see. Yeah, okay. Well, 35-ish is the next level probably. But the coast is clear if this breaks. Okay, let's have a look at the metals as well. Gold is trying to break above a 1935. We were talking about 1935 and 1895 as being the short-term range. These previous highs, there's also a lot of lows here. This is a big level here, and I don't see how metals are going to be resolving ahead of tomorrow in any way. So it's looking positive today, but I wouldn't be surprised if they go back down to unchanged or even negative today ahead of tomorrow's numbers. I think the main numbers are 1895 and 1985 for gold. So a big range, but that's where we have been, going back and forth over the past month or two. And I think that's what needs to be cleared either way for us to say, right, yeah, we have a new trend, a new move, and new targets. Silver is doing okay, but that also needs to break really above 24.50. 24.50 is a massive level for silver. I know it's over $1 away, but this can be done in a day, So again, we wait for tomorrow's number. I don't see any reason to be getting into silver, gold, or platinum today ahead of the number. As I said before, we're up a bit today. We could easily be red within an hour, so I wouldn't chase it. I think that's pretty much it, my friend. Let's see what we get tomorrow.
Yeah, thank you very much, mate. I shall grab that off you.
Yes, thank you.
Second. Where am I going? I've got where to go. There. Right. Share screen. You see that all right?
We do, yes.
Yeah, cool. Yeah, I was going to have a quick nose at gold because I missed out on my TP yesterday by a handful, and I've got my TP in now this morning. And yeah, Stell's right. There is a bit of a zone here, 30 to 40, you can probably call it, right in here, previous level. So can we break here? That's the question. If not, then we do have quite a good range going on down here. It's a nice range to play at the moment, down into 1900. And as Still said, we've got that extension down to 1895, which is the 38.2 fib, as you can see there. Dollar China is on the fritz as well, coming down because of what's happening in the dollar. But another pair where we're not close to breaking trend. The 38.2 of this move is way below in the 706s. So you can see there, not close to breaking a trend. It is holding the levels. This is a sort of price action you want to see if you want to catch a knife in dollar yen. You want to see the old levels holding up. We've got one here, 1920. You always got to look at these with probably a good big figure range. So 19.20 as opposed to just 19 on its own or 20 on its own. Hence why I've got a lot of zones coming in this one. So this one's coming off as well. Fundamentally, this is, and you can say it for the dollar yen as well, fundamentally nothing has changed. Okay, China, we saw that quite clearly with the CPI numbers, flat CPI, so absolutely zero reason for them to not to continue easing policy. And in fact, they are going to be upping some of their property support or speeding that up. So this is really moving on what's going on in the dollar and dollar yen. So again, I'm not quite ready to catch a knife, although this level might turn out to be a bit juicy. We did get what I thought we might get, which was another crack towards the highs, but not quite getting there. And now that's solidified this high area, in my opinion. And as such, we've seen a pullback similar to dollar yen 145s. Maybe down here, if we get a move today, down towards the 717, 716s might be an area I'll try and catch the knife or give it a little go. Don't need to keep it, don't need to put a house on it into something like 717, a stop just below 716. If it's going to carry on going, it's going to blast through there. I don't need to lose a lot to have a go at that one, but I'm not quite sure we're over with what's going on today in the dollar. In fact, dollar yen's now making a new low, 140.29 and change. So that's continuing to move. Hence, I'm not ready to catch the knife yet. And you've got to be careful when you get moves like this, particularly in something like dollar yen, because when it goes and it keeps going. And you think, yeah, I'm going to try there. Yeah, I'm going to try there. Yeah, I'm going to try there. And you get your ass handed to you several times in a session. Don't try catching a knife in something like dollar yen until you start hitting some of the really big levels where it's really worth having a go. And if you're going to have a go, keep your risk small. Okay, you're pissing against a very strong wind. Okay, so if you're going to try it, keep it small. If it works, you can always add on the breaks up. If the price action says that's a bottom, fine, you can add on the way up. There's no point putting all your money on this level, all your money on this level, all your money on this level, and getting your ass handed to you each time. Go small. If it doesn't work after 2 or 3 attempts, sit back, wait for the bigger levels, score your levels, say, right, I've mucked around on this one, mucked around on this one. Where is a level that really might show up? And those are the ones you put your money on. But you still keep it tight, because if they don't work, you don't want to lose a lot. Because if you have 2, 3, 4 losers trying to catch the knife, you've got to make all that back on the next trade just to break even. Okay, so you don't want to be bleeding money out your account, a lot of money out your account. If you're going to fight trends, do it small. And as I say, you can then build up on the way back up if it starts breaking the levels. Add a bit here, add a bit there, take a bit off, add a bit on. Be a bit more dynamic with your trading. Let's have a look at some other questions. Mike says, do I believe that if core CPI comes in at 5% expected or above, will people cover their short USD positions? If inflation is hotter than expected, you are going to see a rally in the dollar. But as we've seen from the last week or so, every time we've had good US data, the dollar's moved up and then got sold off afterwards. So something has changed in terms of the market trading, the fundamentals. So would everyone reverse all of this on a hot CPI number? I'm not so sure. Could we get a decent rally? Certainly, we could get a rally back up to 142s perhaps, if the number's super hot from the CPI data. My opinion is that that's probably going to give sellers who have been shoving this move down more ammo to get in. So for now, the mood is bearish dollar yen, at least in the very short term. And until we get evidence that that's going to change, i.e. starting to form decent bottoms or breaking back up through the levels, I think that rallies get sold here on out. But goldfish markets, last week everything was rallying, or a week or so ago we were wondering whether 147 was going to give way, and we were off to 146, 147. Sorry, 145 was going to give way. Now we're asking whether 140 is going to hold. So markets change their mood and minds very quickly these days, and and you don't want to. You've got to change with that. So as far as the CPI goes, I'm more likely to be a short-term rally seller than a dip buyer for now, anyway. What else have we got going on? Carl, you guys are a bit quiet on the old questions today, aren't you? You've been quiet for a long while, you folks. So come on.
They just agree with everything we say, right?
Yeah, well, it should do. Give us something, guys and girls.
And by the way, Mike, I do agree that Fed speakers are still hawkish, and the most likely scenario is that Fed hikes. But I'm saying if there's a miss, that could easily swing a little bit, you know. Anyway, and saying we're waiting on levels, yeah.
Yeah, and using my excuse there, we're waiting on levels. We're always waiting on levels. Yeah, no, I agree.
That's okay. We covered a lot of ground today, so that's good. Yeah,
it is good. And yeah, I agree with you still what you're saying about the Fed. It's again, and I've been saying this for quite a while as well. It's difficult to say this stuff because it is longer term thinking. The next trade we're going to be trading is rate cuts. So at the moment we're getting to peak. The market is naturally going to switch to trading. Well, okay, if we're at the top, the only way is down. So when's that going to happen? Are we seeing that now? I don't know. We could be. Everything else has to change in the meanwhile. But that's how markets work. We move from phases to phases to phases over many, many months. And all we can try and do is trade in between it. But anyway, okay. Oh, there is a question in the Q&A. Let's see what who's that. Can you have a look at dollar Swissy, says Sam. Okay, quick look at dollar Swissy. I really don't pay attention to this one a lot because of the S&B and what they're up to. And as one of our colleagues in the chat room pointed out, the S&B, their latest comments show that they don't really give a monkey's whether inflation is below 2%. They're still potentially on the hike path. So here we are. We've got looks like a little bit of a break on, just coming in against that prior low from May, around about 88.20. So we're just edging below that at the moment. So that's not a good sign. We do have obviously this prior low down from February 2021. That's going to be something to keep an eye on. But as you can see, I've not updated the text on my chart for quite some time, but it's potentially looking like a bit of a breakdown. If we hold below here, and Sab, give us what you're looking at as well. You know, you're long, you're short, were you trying to long against this low? Or are you looking for a break short? So if we get below this low here, let me stick a line in now. Why not? Boom. If we are getting back below here, and you probably want to take the big figure into account as well. If we start to hold this level on a break, then you know further downside is going to be coming in, and it's going to head lower. You are short, but you think the Feb 2021 low could be a turning point. Well, there you go. Perfect. You're looking at it. Where are we? That down there, coming in at, if I can nail it. Oh, come on, this thing's so jiggly. There we go. So you're looking around 87s. Okay, so if you get down there and you're short, you've got a question to ask. What do? Do you take all your money off? Do you take a little bit of your money off? I would personally, I would manage it with stops. I don't like giving up a winning trade. So if you get down to there, I personally would, if I was in the short, takes a bit of money off the table there, maybe move my stop down to just above this break level here, if we are going to break it. And if it doesn't break, then you're locked in the rest of your profit. If it does break, you can maybe add on a break and see where it wants to go, and then bring your stop down to just above that level. But yeah, if you get the move, I'm not going to tell you how to trade. If you want to take all your money off, that's the way to do it. That's the way you do it. But I like to stay in a trade as long as possible and just see where it goes, even if a little bit. So good luck with that one, Sad, and thank you for your question. Reshi, a lot of talk of blow off the top in equities coming up. Thoughts, Del?
Blow off top.
A blow off?
Blow off top as in one more rally and then reversal. I mean, I don't know. For now, I don't see any reason to be short. That's all I can say. Will there be a bullish reaction on a weak number? Yes, there will be, I think. But for now, I'm just saying I don't see any reason to be short. So if you're long, I would stick with it. If you want to get long, do I chase it up here? Maybe on a break of those highs again. If you break the 44 or 50 or 45, whatever that was, new high. Yeah, I might want to chase it, but definitely wouldn't want to be short here.
No, I think the thing for me is that stocks they're not doing an awful lot. I mean, we've come through Fed, NFP, CPIs, PCEs, all the central banks, and we're still looking pretty bullish. So even you get the intraday moves on the data, you can't deny the trend. And you've been particularly speaking about the trend since we broke up through 40s and whatever, and particularly 42s and 43s, and we're holding it. So irrespective of what's going on in all the fundamental stocks aren't really doing an awful lot, but they're not going down. So that gives you a clue. I think the trend is your friend, as I like to say, and there's no reason to change for the moment. And yet you're right, Gavin, earnings start on Friday, so they're going to be eagerly watched, particularly in the banking sector. So we'll see what they bring from later this week. Okie dokie, folks, thank you for your input today. And let's have more of it tomorrow and the rest of the week when we get set up for the CPI data. It's always good to talk. Thank you, Stelios, for your valued input, as always.
Thank you, Ryan.
And, thank you, viewers. And we shall see you nice and early tomorrow. Have a great day, everyone.
Thank you. Bye-bye.